Welcome to the UTI Swatantra series powered by ET Now. I'm Faye D'Souza. Thank you so much for tuning in. We're going to continue our endeavor to try and help you understand how you can use mutual funds to achieve all of your financial goals. This week, we have a wonderful audience of very, very young people in the studio who have questions about how to get started, how to arrive at a financial goal, and then how to begin planning. And to answer all of those questions with me in the studio, Suresh Sadgopan, he's the founder of Ladder 7 Financial Advisories. And Kaushik Banushali is the founder of I3 Wealth Management. Gentlemen, thank you so much for coming in. We did a quick, sort of check before we started. There are young people in the studio who don't have mutual funds, but they do have fixed deposits, and that makes me happy on one level because I'm glad that they've at least gotten started. So there is a mindset of investing and planning. They'll all graduate from college soon enough and start working. The first salary tends to be spent on things that you've always wanted, taking your friends out, buying something special for the family. Let's start second salary onwards. Ideally, how much money should a young person be putting away from the beginning, from salary number 2 or 3 or 4?
I don't want to be brutal. I don't want them to invest maybe 50% or 70%. Yeah, but the point is, I think they can start small. So normally what happens is when you get your first salary, the first salary tends to be comparatively on the lower side. But there are a lot of items on which you want to spend. It may be the mobile, it may be the movie, it may be the vacation, it may be something to do with the friends, something to do with the family, things like that. So there are a whole lot of things which you want to spend on. So, a lot of times savings do not take priority till about 6-7 years later. So, I think that should change. Maybe 10, 15, 20% of the income, if that can be put aside, that will be a good place to start. Let me start with 10, not 20.
10%, all right.
10% of your salary. Can you put aside 10% of your salary? Yes.
Okay. Kaushik, the other very interesting thing, when we used to start, when I started my career, we were so, far below the lowest tax bracket. We didn't have to worry about tax saving. Now, young people start at a point where they're, at least in the 20% tax bracket and sometimes even higher. So that 10% that I am saving should ideally be going towards tax saving as well, right? So what is the best way to do that?
First, as advice would be straight away to start with the ELSs in mutual funds. So they have a availability of around 1.5 lakh rupees they can put into ATC. So the first objective they should look forward for is to put it into ELSs. That would enable them to save tax straight away in a tune of 20%, as you were saying.
Explain to us how an ELSS works and what it is.
ELSS is basically a mutual fund scheme, where you will be buying the same equity-based mutual funds, but the scheme will have a differentiation of lock-in of 3 years. So your money will be locked in for 3 years. And post 3 years, you can withdraw your money as per your needs. But we would still advise you to stay longer because in the long run, all mutual funds would be giving you exorbitant returns. So ELSS, one good thing is like you buy a mutual fund, you invest into equity schemes, and apart from that, you save tax. So the day one return, if they are into 20% tax bracket, they would take home 20% on the day one. Plus, whatever returns the fund would generate.
So obviously, if I'm saving from my salary on a monthly basis, I should be using an SIP, right?
Absolutely.
Okay. So explain to our audience how an SIP works.
SIP is an habit. Okay, I'll put it that way. Rather than explaining the just the term as a systematic investment plan, I would tell you it's an habit. It's about creating a habit from the day one of investing into the right asset classes. Now, as we come many times, we meet customers, they always tell us, when is the right time to invest? That's a basic question that comes to you. Is this the right time? Is there a right time? I would tell you, investing in equity, always there is a right time. It is not about timing the market, it's your time in the market. So the more the time you spend in the market, logically you're going to make the more returns. And SIP is the best way. Reason one, that you don't have to worry about timing the market, because you're buying at the regular intervals. So in a year you buy 12 times, so your probability of buying right or wrong goes higher. So you end up making 7 right choices, 5 bad, still you're on the average line. Maybe you did not achieve your goal, say in 12 months, extend it to 18 months. Okay. So your time is going to come back. And I would tell you, if the markets were bad, while investing you should be more happy, right?
All right. So tell me this. Obviously, when I start investing when I'm young, so I have different types of goals. Some of them short term, some of them long term. I might want to, take my first foreign holiday in a year's time or in 2 years' time. Maybe I want to buy something expensive for my parents. And then there are the longer term views where, you want to buy a house over the next 10 years, or you want to, you're going to start a family eventually, so you want to put money aside for that. How do you differentiate between short term and long term, and should those plans be different?
Yeah, all of us have goals. So a lot of the goals tend to be short term for young people like this. I mean, absolutely nothing wrong. There is, I mean, you're putting in so much effort. I mean, there is a bit of intelligence which is fine, absolutely fine. So the point is, go for that mobile, go for that holiday, do all those things which you always wanted to do. Absolutely, no problem at all. But the point is, like you rightly pointed out, there are things which you will eventually get around to doing, which maybe you may want to probably settle down in life. Maybe you would want to start a family at some point in time. You would want to buy your own house, and then the children's education, their future, then the retirement planning. I mean, retirement planning, anyone here? Eventually we all have to get there. Eventually we all have to get there. So when I talk about retirement planning to very young people, they say, hello, I have just started. What retirement? Where is retirement?
But I've seen there's been a sort of a change in the approach.
Absolutely.
So when we started and we said, okay, we are going to retire at some point, you want to put money away from retirement. Young people don't want to do that anymore. The goal now is that I will work in a job for some time till I make enough money to start off my own. So I want to start my own company, I want to start up on my own, I want to create something of my own. That is a far more pressing need. It also tends to be a lot closer than retirement. So an average working person has 30 years. Someone who's looking to start up, which I've seen on average is almost everybody, is now giving themselves, say, a 10-year horizon or an 8-year horizon, that I will work only for so many years and then I will start up. So let's assume that that is the new target now. How do you approach that target?
See, the point is, it's ultimately a question of prioritization. It's a question of what you want, how much priority you attribute to a particular goal. Like in my case, I may attribute, let us say, maybe buying a property to be a very, very high goal, maybe a very high priority goal. Maybe in six years I want to buy a property. Then I'll have to allocate a whole lot of money towards that, so that I end up at least paying the upfront money, which is about 20-25%.
Actually, it's also interesting, and I'm going to pivot the conversation a little bit. You are both entrepreneurs yourself. You run your own company. Right. So tell us from experience, Kaushik, when you started off, the first 3 years, 5 years. Now, there's one thing when you're actually running the company and you put in all of your effort and your time and your energy, but it has a big impact on your finances as well, and how you run your money, how you run your household, what sort of family budgets you have. Tell us from your experience what that was like, and ideally, how should I prepare for a time like that?
It's the first and the foremost important thing once you start earning is doing your financial planning. Now, the basic is like, it's not how much money you make, it's how much you save, because that is what is going to count for you for your future. As you were mentioning, we are moving towards a new era where the young generation wants to work for 10 years, they want to get into their own business, and but the overall, if you see, your life expectancy is going up and your retirement age is coming down. Yes. So you're starting working at 25, you want to retire at say 50, 55, but you're surviving till 85. So you have 30 years to make money, and that 30 year has to again fuel you for next 30 years. So if you don't really plan your finances well, the scenario may be quite difficult in coming years. In India, we don't have a social security systems, okay, that would help people to have their old age taken care. So it's we have to plan together.
All right, we're going to have to take a very quick break, but when we come back, we'll talk more about using equity mutual funds. That's on the other side. Don't go anywhere. Welcome back. You're watching the UTI Swatantra series powered by ET now. All right, I want to open the floor for questions because we have a very interactive audience today. Anybody who has a question on anything to do with money, feel free to ask.
My question is, thinking with the mindset of a common investor, especially a new one, He thinks real estate is much better option for him. It's more tangible, it's more risk free, it's giving him phenomenal returns in today's market. A property bought for 15 lakhs in 2000, it's of 1 crore right now. So why should he even consider investing in mutual funds when he thinks it's a gamble?
How old are you?
I'm 19.
You're 19 years old. Okay. And when do you plan to buy property, if you believe in it so
In
strongly?
2-3 years maybe. I started a business with my father. I'm helping him.
Okay. Traditionally, we've always loved property. We've always loved gold in this country. They're both tangible assets that you can feel and touch, and you know they're not going anywhere. Vis-a-vis investing in demat form mutual funds. What are the arguments towards equity and towards mutual funds at this point?
Yeah, first of all, let us not really get into a slanging match between mutual fund versus real estate versus FDs and other instruments. See, each has its place in the portfolio. But the point is, a lot of it is actually not really going great as far as real estate is concerned. Real estate as an asset class requires a whole lot of money. So the point is, number one is that as far as real estate is concerned, in your case, probably you may buy a real estate from the point of view of staying. So I don't have anything against that. So you would want to buy a property, you want to stay. So that's consumption, perfectly fine. But the point is, you are actually putting a whole lot of money into one place, which is essentially concentration risk. There is a bit of concentration risk in that. And it is not that real estate has always given very good returns. We are going by the experience from 2004 till now. 2004 till 2013. Property is not doing well at this point in time. So there are cycles. So in any asset class, there are cycles.
I want to talk about the returns of equity over the longer period of time. The young man mentioned 15 years between 2000 and today on real estate, and it's true. The returns from real estate over that period of time have been quite phenomenal. Compare it to equity and tell us what the returns have been on equity.
Equity, if you track the data for last 30 years, it has given the CAGR of 17+%. If I talk about Sensex itself or Nifty itself, or even if you go with the 15-year data, it has crossed 17 to 18%. And comparatively, if you look at mutual fund schemes or the top performing mutual fund houses, they have always outperformed Sensex by 4 to 5%. So if I go back and look at data of some of the diversified equity funds, they would be in a tune of CAGR of around 20-22%. So if you are at age 25 and if you plan to retire at age 50 and you want a 1 crore as a corpus, at 14% CAGR, you would just need to put 3,700 rupees per month.
Okay. Yeah,
that's a simple calculation. And I'm telling only the thing that you need to track is 14% yield. That's all.
All right. Do we have any more questions? Would anybody like to ask a question? Yeah, I'll go with the young lady at the back in the red.
I'm also very much interested in investing in real estate, but before that, I've just started my career. So I want to know, as a first-time investor, what should be my plan? Is it, I have heard about that compounded plan in which mutual funds and equity funds all are backed together. Some money should be invested in mutual funds or equity, or I'll go individual plans. I want to ask that.
Normally in the case of mutual funds, we tend to think that it's all equity funds. That's not the case. In fact, 70% of the mutual fund industry is in debt. It's the debt portion which is the predominant majority of the mutual fund industry. So apart from that, I think what you were mentioning, what you are talking about are all hybrid funds, or they call it asset allocation funds. So in asset allocation funds and hybrid funds, there will be more than one asset class. So there will be probably an equity, there may be gold, there may be debt. In some cases, it may be equity and debt. So typical hybrid funds will have only equity and debt. So now if you do not want to do the asset allocation yourself, if you do not want to balance the portfolio from time to time, and you want the portfolio manager himself to do that for you, then a hybrid fund will be suitable for you. Again, even in terms of hybrid fund, there are equity oriented hybrid funds and there are debt oriented hybrid funds. In the case of equity oriented hybrid funds, typically equity will be 65% or more, and in debt oriented hybrid funds it can be as high as maybe 80-90% in debt. So depending on your risk appetite, depending on what kind of returns you are expecting and what kind of risk you want to take, you can look at hybrid funds also. So but normally as financial planners, we generally do not look at hybrid funds at all. We look at individual asset classes because it is easier for us to track vis-a-vis the index. So if there is a fund which is directly tracking Nifty I would want to track whether it is beating the category and beating the index, and I would want to stay invested in those kind of funds. So we do the monitoring from time to time. But in your case, if you want to play it safe and if you want to invest in a hybrid fund, I think that's perfectly fine.
All right, let's take the question from the young lady in the front.
What kind of risk is involved investing in mutual funds as compared to investing in equities?
Direct stocks vis-a-vis using a mutual fund. Okay.
So as far as equities are concerned, suppose you are investing in company A or company B, you need to know about that company, you need to know about the financials. Don't tell me that your stockbroker told me and that is why you invested in that. So that's not how you should actually be investing, and but that is how majority of the people are investing today, unfortunately. So now if you do not want to do that, if you do not have the time to track all that, then mutual fund is the right way to go. So that is a fund manager who actually pulls all the money that he or she collects from various investors, and then that corpus is invested in a particular manner based on the objective of that particular scheme. So based on that, then you don't have to do anything. Suppose it's a large cap oriented fund, for example, the fund manager himself or herself will be putting that money in various large cap oriented funds as per the objective of that scheme. So all you have to do is you have to look at the portfolio from time to time, maybe once in 6 months, once in a year, to see whether it is meeting that objective. You might have had a particular target in mind, which may be 12, 13, 11%, 14%. So more than the target, what you have to see is whether it is able to meet the benchmark. There will be a benchmark for every single mutual fund scheme. So the most important thing is you are paying a fee for that. So there is an expense ratio there. So is it meeting the benchmark and is it beating the category? So these are two important metrics that you have to see. And the other thing which you will also have to see is the risk metrics. So there may be fund A and fund B, and one fund may be able to perform at a better level as compared to fund B, but the fund B may be taking much more risk as compared to fund A. So you have to look at the risk metrics also, apart from just the broad returns alone. So it's much better for a normal retail investor, in fact for most of us, to invest through mutual funds as opposed to direct investment in equity.
Say for example, you want to start an investment of 10,000 rupees. So you may end up buying say X number of stocks. So your diversification can be into a limited say 3 to 4 number of companies or stocks. Compared to that, if you're going with the mutual fund, what happens is your same money is diversified into approximately 50 to 60 stocks. Also, there is a fund manager available who is qualified to manage your money, okay, who will take the rational calls or situational calls to maximize your return. So if you are not putting your 100% and time, I would always advise you to go ahead with the experts who's been doing that job for quite some time.
On the other side, we talk more about mutual funds and answer more questions. Don't go anywhere. Welcome back. You're watching the UTI Swatantra series powered by ET Now. Thank you so much for staying with us. We're going to try and answer more questions from our young viewers before we wrap up the show. The gentleman in the back, go ahead.
If I invest in the mutual fund, the returns are same in both the market. If the market down and up, if the market fall and down.
Will a mutual fund give me good returns in a bad market and a good market?
Mutual fund will not give a good return in a bad market, because if the market is bad, the constituents which goes into the mutual funds also will be giving bad returns at that moment in time. It is the fund manager's job to cushion the fall. But the point is, why are we looking at short term? If you are looking at short term, like if you want to buy a house in the next 2 years, we are not going to suggest you an equity fund at all. We are going to suggest you a debt fund. In fact, up to 3 years, we don't suggest anybody who has goals up to 3 years, we don't suggest equity funds at all, because equity is for the long term. So we will be suggesting debt funds of various duration. So now if you are really looking at the long term, you have to look at the appropriate kinds of funds to invest in. So volatility is a part and parcel of the equity market.
But the longer I stay invested, the lower the volatility is.
Absolutely. The longer you stay invested, the lower the volatility, the higher the chance of you making money. Having said that, there is another thing that you also have to keep in mind. There is something called risk tolerance. Every one of us have an intelligence quotient. Similarly, every one of us have a risk tolerance level which we are almost born with. So there is research which says that each one of us is born with a level of risk tolerance. Risk tolerance typically is measured in terms of volatility. I mean, how much volatility can stomach, or rather if the portfolio comes down by 10%, 20%, 40%, are you willing to accept that? Some people may not be willing to accept that at all. They will not be willing to accept even 2% degradation in their capital. Some people may be willing to stomach 50% reduction in their capital. So where do you stand there? So you have to evaluate that, and then according to that you have to invest in equity for the long term. You can make money in equities only in the long term. You cannot really make in the short term. Maybe by fluke you can, and a lot of people who have made money by fluke think that they are aces and they put more money, and that is where people tend to think that equity market is gambling. Those are the people who give bad name to equities. Equity is a proper investment. You should know how to play the equity market.
And the best way to go ahead is you start with an SIP. If you look at an SIP for 12 months or 2 years, you would yourself feel that you will keep adding more. So it's about starting a right habit at the right age.
And the beautiful part about an SIP is that the minimum amount that you can invest in an SIP is 500 rupees a month, which technically is less than what you spend in a multiplex watching a movie. So you can actually take that risk in the first 1 year, 500 rupees a month, see how you feel. If you're confident, if it makes you feel good, then start to invest more money. You had a question.
I plan to start my own business in the near future. So how should I look at savings, and how should I prefer to invest from my own pocket for that business?
In how many years will you plan to start your own
3
business?
years.
In 3 years. Have you started working yet?
1 year ago.
Okay, so you've been working for a year, you plan to work for another 3 years and then start your own business. You want to take that, Kaushik?
Right. So, see, first, I'm really happy that your goals are defined. That's the first thing you need to do in financial planning, that you should have a realistic and a specific goal that can be quantified. So once you have quantified your goals, what we can do is you can do the reverse calculation. So now, as an advice, I would tell you this: just identify what is the startup capital that you would need. Okay, once that is ready, you would get into the business. So say, for example, you need X amount of startup capital. Now come back and do the reverse calculation, that the number of months available with you to reach that goal. So say, for example, if you want to start in 3 years, so you have 36 months. So now apply the rate of return that you would expect on your investment. So that would give you a monthly amount. This is the monthly amount what you need to put aside. And if you're able to do that, I'm quite sure that 4th year, 1st month, he would be into the business.
All right. So lady in the front has a question. Go ahead, ma'am.
You said you will always make money in the long term in the mutual funds, right? Now, I want to know how long is the long term?
See, ideally we look as an horizon of 5 year plus. That is what we advise. But again, sticking to the nature of the business, I would not guarantee anything. But in a long run, say 5 year and plus horizon, what happens is the market moves from a different cycle to a different cycle. So you may see up and down both, and it will always give you a chance of reaching to your goals, or rebalancing your portfolio in that period. So you may not reach your goal in say 5 years period, but yes, eventually say 6, 7, 8 years you would reach. So it's about, again, it's time in the market, right?
Yeah. We're running out of time, but for me personally, the takeaway from this show is, if we look around the room and see how many young, ambitious people are going to hit the workforce in the next couple of years and then start their own businesses, it means that we're only going to have a stronger economy, if this is any indicator of the rest of the country. And that's reason enough to invest in equity, because equity grows when your economy grows. So takeaway for me is to invest in equity simply by what I see in this room. I'm always looking to make a profit, so that's what I'm going to do. All right, we've run out of time. Gentlemen, thank you so much. It's been a wonderful show. I've loved chatting with you, and you've been a wonderful audience. Thank you for spending time with us. If you watching at home would like to join us in the studio for any of our shows, log on to our website. It's at the bottom of your screen. You can also tweet out a question, #Swatantra. Thank you so much for watching.
Brought to you by UTI Mutual Fund. हक एक बेहतर जिंदगी का.
Mutual fund investments are subject to market risks. Read all the scheme-related documents carefully.